Good morning. Today is Wednesday,
October 21st.
and thank you for joining us for another edition of the Market Commentators podcast. My name is Jake Willms. I'm a quantitative analyst with the Milwaukee Company, and I will be serving as the moderator of today's podcast. Joining me is Mike Willms, who is TMC's Chief Operating and Compliance Officer, and of course, Andy Willms, who is our CEO and President. Good morning, gentlemen.
Good morning, Jake. Good morning, Andy.
Good morning, Jake. You left out the fact that I'm also your father.
Can't forget that
Truly
part.
a family affair.
And Mike is your uncle.
Yeah,
So
that's
it
true.
truly
It's
is
a big
family
Willms
affair.
podcast here.
Although lots of other people working here that aren't Willmses. So it's not, the
Yeah,
whole
that's true.
operation is not a family affair.
A quick reminder that nothing in this podcast should be construed as investment advice, and the views expressed represent Mike, Andy, or my personal views, and not those of the Milwaukee Company. Let's get started then, Andy, with a market recap.
I'd be glad to, Jake. Let's start with what happened last week. The Dow Jones Industrial Average and the S&P both fell for 3 straight days last week, which was the longest slide since mid-September. The major indexes kind of eked out a gain on Friday to snap their losing streak. Then this week, Wall Street's been struggling as lawmakers are trying to reach a deal on the coronavirus stimulus deal before the election. On Monday, the Dow Jones lost 410 points, which amounts to 1.4%, and the S&P slid 1.6%, and the Nasdaq was down 1.7%. All three of the major indexes closed a little higher yesterday, as House Speaker Nancy Pelosi said both sides had made progress in their stimulus negotiations and wasn't going to enforce her deadline that she had put on it, which expired yesterday. But Senate Majority Leader Mitch McConnell had come out and said he's not in favor of a deal before the election, and he's discouraging the White House from doing so. So that pretty much brings us up to date, I think.
Well, I think the interesting part about that, Andy, is that, essentially now both sides have caved on their deadlines here. And I think everybody recognizes there are people in the U.S. that really need some help at this point.
Right. And why they even bother setting deadlines is beyond me, because they very seldomly enforce it. But such is the world of the politicians.
Yeah, it is very true. Hey, Mike, how about you bring us up to speed on what's going on in the economy with an economic update?
Well, I know that there's been some concern about a potential slowdown, but there's been some real positive as well as some question marks. The consumer spending was up at a much faster pace than expected in September, with retail sales rising at a 1.9% rate. And consumer spending remains the largest driver for growth in the economy. The major part of the uptick in consumer spending related to used vehicles. People are shunning use of public transportation, and that's led to a large jump in used vehicle sales. Ex-autos, retail sales were up 1.5% in September. And interestingly, as an indication of what's happening with used cars, AutoNation reported earnings this morning. And while the expectations were for them to report $1.65 per share, earnings came in at $2.38. So there is a move away from public transportation based on concerns about the virus. Mortgage rates continue to hit new record lows. The average for a 30-year fixed mortgage dropped to 2.81%, down from 2.87 last week, and that's the lowest in almost 50 years. I have to admit, I'm in the process of trying to take advantage of this opportunity here. I mean, it's hard to believe you can borrow money for 30 years at those kind of rates. But on the downside, the number of new applications for unemployment benefits rose more than expected last week at 898,000. That's the highest level since late August, and layoffs remain persistent, and some of the layoffs are now getting to be permanent, with some of the previous stimulus packages running off, and specifically cutbacks in airlines and some of the transportation related businesses. So on the good news side of it, though, the continuing claims number, the people that have been filing for unemployment week over week, dropped to essentially 10 million claims, and that's down from a peak of 22.5 million in the first week in May, and is more in line with what the depths of the financial crisis look like. So we're on the mend, but not as quickly as most economists would hope. And then that gets us to kind of the shining star in the economic recovery, which is residential housing. Housing starts were reported up 1.9% on a seasonally adjusted basis this morning to an annual rate of 1.4 million, which is more than double the trough during the financial crisis. So that kind of covers the high points.
Awesome. Thank you, Mike. And before we get on to our roundtable discussion, as usual, I'm going to bring our listeners up to speed on the COVID front. So unfortunately, no good news to share with COVID. This autumn wave has proven to be dangerous. As of the 20th of October, U.S. deaths are rising, U.S. cases are rising, daily tests reported are rising, patients in the hospital are also rising. These values are reaching 456 for deaths, 57,000 for new cases, 1.26 million for new tests reported, and over 37,000 for patients hospitalized. The number of new daily cases has risen almost 50% in the US over the last month alone. This is really interesting, such a sudden shock in rising cases. Don't you guys agree?
Well, the one thing that I would point out is it's been a fairly rapid escalation in the number of tests being provided. It was just a month ago, tests were still more in the $900,000 tests a day range. So we're getting better at testing, which unfortunately is going to catch more of the infections in the population.
It's also interesting that you see a lot of the new infections in Wisconsin, where of course the three of us are. We've been making a lot of national news, and in the Midwest in general, Illinois has come up a great deal. You've also seen increase out east in New York and New Jersey. But I think it's really surprising to see how this has really developed in certain regions of the country. The sudden spikes.
The situation, oddly enough, is even worse in Europe than the US at this point, because for the first time since late March, the per capita number of new cases in Europe has exceeded that number in the US. Really surprising.
Yeah. And I don't know if you guys heard it, but this morning there was an announcement that researchers in London are planning to deliberately infect people with the coronavirus in the world's first attempt to study how vaccinated people respond to it. So
really,
yeah, and this approach, it's called a human challenge, could shorten the time needed to find a viable vaccine, right? But it's also raising a lot of ethical concerns, because what happens if someone you deliberately infected ends up getting very sick or dies from it? But
exactly, and wow, I think what they're targeting is are younger candidates, where there's less of a possibility of a severe infection. It would be a small viral dose, a minimal amount of a manufactured virus to minimize the severity of the infection. But the ethical considerations around any kind of challenge trial are just huge, especially in this particular case where there isn't a known therapeutic.
Right. But then again, this is not the first time it's been done. it's been done in the past, of course, and now we do have therapeutics that really have dramatically improved the survival chances for people who get really sick and end up in the hospital. I mean,
Exactly.
I don't know. I heard some statistics this morning. I can't remember off the top of my head, but the percentage of people who get hospitalized and die has dropped dramatically. So it's only a very small people who percentage get hospitalized, and of those who get hospitalized, far, far fewer are now dying because they know how to treat the disease. So,
well, and there is a belief that where remdesivir doesn't provide as much of a benefit for somebody that's severely ill, if it's given at the start of the infection, it is much more effective.
Right.
And then I guess the one statistic or comparison between government or economic systems is they have conducted a challenge trial in China, and the patients are paid $60 to participate. The participants in the challenge trial in London will get 2.5 million.
Sign me up. I'm not young enough, I guess, to do it, but Jake, you could probably pull it off.
No kidding. All right, gentlemen. Coming up next, we're going to have a round table discussion. I've got a bunch of great topics to discuss with you guys today. I'm excited to hear what you have to say about a couple of these. I'm going to be starting off with a question for Mike. So, as we enter the countdown to the November election, the odds of a so-called blue wave, which is where the Democrats capture the White House and a majority in both houses of Congress, this seems to be increasing in likelihood. At least 5 of Wall Street's market pundits are predicting a sweep for the Democrats, with Goldman Sachs putting the odds of the Democrats getting control at about 65%. So my question for you, Mike, is do you think a blue wave would be good or bad for investors?
Well, I mean, you can make the argument on both sides, but I would kind of lean towards it would be more of a market negative relative to the anticipation of increased taxes and the potential for a rise in interest rates relative to additional deficit spending, financing a COVID-related stimulus package.
Jake, if I could just chime in a bit, I'd also say to you, it really depends if you consider yourself an investor or a gambler. Because, if you're an investor, you probably don't want to make a major change in your portfolio because in this particular instance, the outcome is too uncertain. And even if you knew what the outcome was, how it would affect the markets is far from certain. And I guess I also want to point out that, the big issue here is how much stimulus, how much government spending there's going to be to fight off the coronavirus. But I did see a very ironic statistic, and that is that while the stimulus programs are being promoted by the politicians as a way to help the middle class, it's estimated that 1% of the population, the wealthiest 1%, own 50% of the stock market, and the top 10% own 80%. So and we all know that this stimulus money a lot of it rolls right into the stock market, has been the biggest contributor to the reason for the stock market rallying in the midst of this whole pandemic. So, it seems to me a lot of these stimulus dollars are going to help the wealthy, not the middle class or poor.
Well, and I think the flip side of that, and that's a great observation, Andy, is if you look at what's happened with the savings rate, whereas the stimulus money has been distributed to the middle class and the people in need of support, it's gone into their savings accounts. With the savings rate, it's steadily dropped here from May, but it's still at 14.1%. And we're on pace for a $2.35 trillion increase in personal savings through the stimulus packages that have been distributed to this point.
I think you guys made some really good points. I'm excited to see how this turns out because I know a lot of the focus the last couple of weeks has been regarding this election. But we're going to move on to a new topic, this one for Andy. This one's going to be regarding capital gain taxes. So, the increasing chances for this Democratic sweep, as we just discussed, has taxpayers starting to wonder whether it might make sense to trigger their capital gains prior to the end of the year. Mr. Biden has proposed to increase the tax rate for the high net worth individuals to approximately 39.6% on all types of capital gains. And because under his plan, death may no longer be an event that eliminates built-in capital gain assets, it's worth asking the question, should investors sell appreciated stocks to trigger their capital gains now rather than later? What are your thoughts?
Well, it depends on your personal circumstances and how much you believe that what Biden is proposing will ultimately become law. According to the Tax Policy Center, Biden's plan would eliminate the step up in basis, or I should say, would tax capital gains on gifts and inheritances for everyone, but it would only raise capital gain taxes on taxpayers with more than $1 million in income. So if you think Biden's plan is the one that would be passed if there were a blue wave, then unless you have $1 million or more in taxable income, you probably aren't going to save any taxes by triggering them early. But by the same token, some people are suggesting that, because there's been all this massive increase in federal spending combined with Democratic control, ultimately the bar for who has to pay more taxes will be lowered. And so taxpayers with much less income might ultimately have to pay higher capital gain taxes. So my takeaway on this is, if you've been holding off on paying capital gain taxes because you wanted to pass on, you wanted your heirs to inherit the assets and get the benefit of the current step up in basis that occurs at death, that probably is less of a reason to do so if there's a blue wave. And I would say too, if there's a blue wave and you've been postponing improvements to your portfolio because you didn't want to pay capital gain taxes needed to sell stuff, I would say that's probably going to be less of a reason not to make the improvements once the Democrats, if it turns out the Democrats get control of both the White House and both houses of Congress.
Well, and I think the interesting consideration there too is if there is a Democratic Senate, if you need 60 votes, you're still going to need someplace between 10 and 13 Republicans to go along with the Democrats. So it'll be interesting to see where this ultimately plays out.
I'm gonna actually, if you don't mind, I'm making a shameless plug for our newsletter. I'm going to be writing about my newsletter article on just this topic. So any of our listeners who are interested in a little deeper discussion of it, check out our newsletter this week on Friday.
Yeah, our newsletter is another great avenue for content if you're not already aware. We do a weekly newsletter on Fridays covering a wide range of topics, from trending articles written by myself to more technical analysis from our Director of Analytics, James Paserno, and of course, a nice market musings post from yours truly, Andy Willms. So if you're looking at learning more about our newsletter or wish to sign up yourself, please visit us on our website at www.themarketcompany.com and go over and check out the media tab where you can learn about our other options. All right, guys, I have a third topic for us here today. This one is one I think is really interesting, less about politics for once, and this is going to be about the economy. And this one's going right back to Mike. So, the economy appears to be flashing signs of a slowdown, as reported with the uptick in unemployment claims. Monthly job gains have cooled. Job growth in postings and consumer spending have also cooled down. More workers are reporting their layoffs to be permanent, as you mentioned. So my question for you is a simple one. How concerned should investors be about this?
Well, interestingly, Lael Brainerd, the head of the Cleveland Federal Reserve Bank, spoke directly to the need for additional stimulus this morning. And her concern is that there hasn't been enough done, and what has been done to this point, trying to stimulate the economy, has been very unequal and uneven. So I think the need for stimulus, absent stimulus, I think there is a real potential for a slowdown. But by the same token, it'll probably be the largest quarterly increase in GDP growth when it's reported here at the end of the month. So, it's really going to be dependent on what the economic indicators are showing here at the start of the fourth quarter, whether in fact we're ultimately going to experience a slowdown in recovery.
It feels like there's a lot of different forces here at play that seem to be kind of fighting against each other. The stimulus on the one hand, the expectations about the election on the other hand. It seems like a kind of a messy situation. What do you think, Eddie?
Well, and I think you're right, Jake. There are a lot of pros and cons here, and it's very difficult for anybody to predict what's going to happen next in terms of the economy, because there's all these political considerations that are, mucking up the ability to forecast what's to come. So my view is it depends on how much risk you want to take, and I've talked about this in the past. If investors are trying to keep a constant level of risk and economic risk is rising, then it probably makes some sense to take some risk off the table by reducing your allocation to risk assets like stocks.
Could you start at if investors, because it didn't really, something happened with the investors there.
I'm going to start from the beginning because it's hard.
Yeah, no, it's okay. Yeah, just something kind of cut out when you were saying investors, and I wouldn't be able to fix that.
Okay. Well, Jake, I think it all depends on, your perspective and your investment objectives. If you're trying to maintain a constant level of risk, you have a certain level of risk you're trying to target in your portfolio, and economic risk has gone up, which it clearly has, then it probably makes some sense to lower your investment in risk assets like stocks. However, if you're a younger, longer-term investor who's not all that concerned about short-term volatility, then I would not let the current economic situation change your asset allocation. But I would tell myself, I look myself right in the mirror, and I would say to myself, listen, I know that the market could go down significantly. I'm in this for the long haul, and I'm going to tell myself now that I am not going to sell even if the economy worsens and the stock market worsens, because 5-10 years from now, what happens today won't matter.
Yep, that's a really good point. I wish, I could say, gentlemen, that we're able to put aside all of the politics and COVID-related concerns, but I just don't think that that's going to be the case, and that's realistic for the short term here. Well, with that, gentlemen, I think it's about time we wrap up this podcast. Thank you for joining me and listening to my first ever hosted podcast. Please keep in mind that you should not act on anything you have heard in this podcast until you have discussed it with a qualified financial professional who is familiar with your personal situation and your investment objectives. Also, please note that there will not be a podcast next week, as Andy is going to be on vacation. So this is going to be, this is our good podcast. We get a nice break, but rest assured, we will be back the following week with another podcast for everyone.
One last thing, we are conducting a short media survey to learn about your thoughts of our weekly newsletter, podcast, and market update. The results will help us improve the information we share with you, and the survey should only take about 5 minutes or so to complete. We would greatly appreciate your feedback, and you can find the survey in your email.
Any final send-offs, gentlemen?
Well, I mean, I would point out that Andy is embarking on an epic adventure driving his 1976 GMC RV down to Florida.
And I would point out that Mike is going to be my co-pilot for that epic adventure. So wish us luck.
It's going to be interesting to see how that goes.
We'll report back on the resuming of our podcast in 2 weeks.
All right, guys. Thank you for your time. Have a great rest of your day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.